Hi viewers, this is Dr.GUDIPATI. I am certified financial planner. I am here to present you the concept of financial planning with mutual funds. In this presentation, you will get an idea of financial planning of mutual funds. How to use mutual funds for a better financial plan for our own investments. You will learn in this presentation. Before starting my presentation, I request you all subscribe my YouTube channel Gudipati Srinivasarao. You will get all updates from my YouTube channel from time to time. The YouTube videos are uploaded by me which are purely relating to an education purpose, the mainly investor awareness point of view, not any commercial purpose. Being an academician, I feel that is a primary responsibility of a teacher to share my knowledge to the required people. This is the motto of starting my YouTube channel. Once again, I request you all subscribe my YouTube channel Gudipati Srinivasarao. You will get all updates relating to the stock market. We will learn the concepts relating to financial planning with mutual funds. So in this presentation, I have taken the content from AMFI Concise Guide, AMFI Investors Concise Guide. AMFI is an association relating to mutual funds. AMFI is working on development of the mutual fund industry in India. AMFI is a body which is working on development of overall issues relating to the mutual fund, the industry. They have prepared one beautiful content. Simply, we can calling it as the Investors Concise Guide. I have taken up that content information for giving the more information to all categories of the public. So once again I repeat, this presentation is made for investor education purpose, not for any commercial purpose. In this presentation, I am not promoting any company products. Now before starting my presentation of financial planning with mutual funds, just go through the Warren Buffett beautiful quote. See the quote? Do not say what is left after spending, but spend what is left after saving. This is a beautiful mantra of an investor. Warren Buffett is a great personality in the field of stock market. According to Warren Buffett, he is urging that every individual should plan for investment portion of their respective incomes. Then whatever the amount left over, then they can go for spending. But normally what we are doing in our regular course of life, we are spending the money first. Is there any balance left over? Then only we are planning for the investment. If we are following like this, we never ever will be ended up with the fruitful results. So that to follow the strategy of Warren Buffett. Now see that what is mutual funds? I have given enough explanation regarding mutual funds in my previous videos. Once again I repeat, mutual fund is nothing but a collective investment vehicle. It is a pooled fund from different categories of investors. That pooled money is managed by a professional personality, calling it as simply a fund manager. A fund manager manages the fund and invests the fund amount accordingly the fund objectives and earning the returns on the fund and handing over that returns to the unit holders. This is the structure of the mutual fund. We have already learned about the concept of mutual fund. Now the objective of this presentation is how to pick up the mutual fund portfolio according to our will and wish, according to our capacity as an investor. So that is the whole idea of this presentation. So before going to start that financial planning, first you must understand what are the approaches in financial planning. Normally there are three approaches. One is the aggressive approach. Another one is aggressive approach number one. Number two, the conservative approach. Another one is the moderate approach. First of all, understand these three approaches. Then identify yourself which approach is perfectly suitable for you. Then accordingly, such approach you follow your investment pattern. Now have a look on three categories of approaches. Aggressive plan. Now in aggressive plan, just observe the combination or a portfolio. So percentages, just observe that out of 100% in aggressive plan, the allocation is as follows: 60 to 70% the growth schemes and 10 to 20% balanced schemes, 10 to 15% income schemes, and finally 5% money market oriented schemes. If you are a category of an aggressive person, aggressive investor, here aggressive person means aggressive investor. Here the characteristic aggressive means accepting the risk up to certain level for anticipating a good amount of returns. Such category of person we can say aggressive investor. Now see the feature. This plan is perfectly suitable for such category of people. Investors in the prime earning years. Is there anybody in prime earning years so that they can go for this aggressive plan? Not only those people, the people who are ready to take some extent of the risk level and anticipating a good amount of returns, such category people can go for aggressive plan. See, once again, see the combination in aggressive plan, 60 to 70% growth schemes. Here, regarding the schemes, I have given enough information in my previous presentations. Growth schemes, mostly equity-oriented schemes. Balanced schemes, a combination of equity and debt category schemes. And income schemes, mostly the debt-oriented schemes. And money market schemes, liquid-oriented schemes. So this is the structure of aggressive plan. These are the percentages of allocation of your money. Now you will see that second category of plan. Second category is a moderate plan. Now in moderate plan. So before going to that moderate plan is suitable for investors seeking income and moderate growth, and investors looking for growth and stability with moderate risk. People, those who are anticipating a stability and a moderate risk taking capacity, such category people, they can go for moderate plan. According to moderate plan, here the allocation as follows: 30 to 40% growth scheme oriented and 40 to 50% balanced schemes, 20% income oriented schemes, and 10% finally money market schemes. So this is moderate plan. But in moderate plan, we can anticipate a growth, stability, and a moderate returns. Now the last category of the plan is conservative plan. Here in conservative plan, the investment pattern as follows: growth schemes 10% and balanced schemes 20 to 30% investment, and income schemes 50 to 60% and money market schemes 10%. This kind of combination normally calling it as conservative plan. This is suitable for people of retired people and who are expecting a regular source of income, who are not able to take high amount of risks. Such categories of investors can go for conservative plan. Have a clear idea about the plans. So one is aggressive plan, we have seen that. Second one is moderate plan. Third one is the conservative plan. Aggressive plan, we can suggest the people, those who are able to accept the risk of certain level and anticipating higher amount of returns. And moderate category means and stability of returns we can anticipate, and the average rate of returns we can anticipate in this particular category of plan. Finally, conservative plan. Conservative plan will give you a nominal returns with low risk and the stability also. This kind of plan we can suggest the retired persons and the persons those who are not able to take the risks. So this is a simple way of using your portfolio for investing. Just once again have a look. Aggressive plan 60 to 70 growth scheme, 10 to 20 balanced scheme, and 10 to 15 income schemes, and 5% money market. So this is the structure of aggressive plan. Moderate scheme. In moderate plan, just see that the pattern once again. In growth schemes 30 to 40% we need to invest, and balanced scheme 40 to 50, and income schemes 20%, money market oriented schemes 10%. Finally, the conservative plan. In conservative plan, just observe that 10% only in growth schemes, in balanced schemes 20 to 30%, in income schemes 50 to 60%, and money market schemes 10%. Just observe in conservative plan, and majority of the portion 50 to 60% invested in income schemes. So this is the structure of different plans: aggressive and moderate and conservative plan. Choose a plan according to your the level of investment. Now, before going to invest, just observe the risk return hierarchy of the instruments, mutual funds here. Here, in debt-oriented schemes and equity-oriented schemes, I have taken into account. In debt-oriented funds, there are different schemes. Observe different schemes, the risk capacity and the return. Like in equity-oriented funds, there are different schemes and the risk level and the return level. Just have a comparison, then choose your the investment partner properly. In debt-oriented funds, just observe the schemes: complete debt-oriented or hybrid fund. So in this case, we can have higher amount of risk and higher amount of return comparatively other debt-oriented schemes. Now, gilt and bond funds, comparatively debt-oriented or hybrid fund, gilt and bond funds having less risk and less return comparatively debt-oriented hybrid funds. In a similar way, other funds also, in other schemes also. In short-term funds, comparatively gilt and bond fund, short-term funds will give you lesser risk and lesser amount of return, like other schemes also. In a similar manner, equity-oriented funds, and observe the different schemes in equity-oriented funds. In equity-oriented funds, sectoral funds having higher amount of risk and possibility of higher return. In equity funds, the sectoral funds will give you the maximum return and the risk. So risk is also high in sectoral fund and the return is also high comparatively other equity oriented schemes. In mid cap funds, comparatively sectoral funds having less risk and less return, like other schemes also. In equity oriented, equity saving funds will give you the less returns and the less risk also. This is the higher risk return hierarchy. We can say in which scheme having higher risk, in which scheme will give high returns. We can understand with this risk return hierarchy. After having a complete idea about the plan, either aggressive plan or moderate plan and conservative plan, after that take into account risk return components, then go for investment of the mutual fund. How to invest in mutual funds? How to select a best mutual fund? There is a process in a step-by-step approach. Here, first step, before going to invest, you must understand why are you investing, so that you can have an idea. After that, select the plan, either aggressive or moderate or conservative. So after finishing of the first step, understanding the reason for your investment, go for the mutual fund ratings. So you can get the mutual fund ratings of the concerned websites of the mutual funds, or you can obtain a different websites also we have. AMFI also maintains the all mutual funds, the rankings and the performance. So, by observing the ratings and rankings of the mutual fund, you can analyze the mutual fund. Then we can go for step 3. In step 3, observe the load or an expenses on a mutual fund investment. So that after careful observation, by comparing each and every fund, you can go for fourth step, AMC. What is the AMC here? AMC means asset management company. Asset management company is a company which is managing the fund, mutual fund. So observe the AMC track record and do some research on AMC. What is the earlier track record, how that particular AMC is operating and all. After careful observation, select the particular AMC. After fulfilling all the steps with a disciplined approach, invest regularly and do your mutual fund investment properly.